Jay Sarno stood beneath the towering Roman columns of Caesar's palace, a casino he imagined as an empire rather than a gambling hall, its marble floors reflecting chandeliers that had cost more than most strip hotels were worth a decade earlier. The resort opened with 680 rooms, a 14-story tower, and a $1 million opening party, funded in part by $10.6 million in borrowed pension money, an audacious bet even by Las Vegas standards. Caesars didn't just attract gamblers, it rewired how the city sold luxury and power. Yet, within 3 years, Sarno was gone, stripped of control. If Caesars changed Las Vegas forever, why did the man who built it lose everything almost immediately? Jay Sarno did not arrive in Las Vegas as a gambler, a mob proxy, or a strip insider. He came as a hotel man shaped by post-war American hospitality, someone who believed that people didn't travel for games of chance. They traveled for how a place made them feel. Sarno's early career unfolded in conventional hotels, where margins were thinner but control was clearer. He learned that guests paid more, stayed longer, and returned more often when their surroundings told a coherent story. Comfort mattered, but so did scale, rhythm, and the subtle signals of status. Ceiling height, lighting, the length of a walk from lobby to room. These were not aesthetic details to Sarno. They were levers of behavior. By the early 1960s, he had internalized a conviction that would define his career. Gambling was not the product. Gambling was the engine. The product was atmosphere. This belief set him apart in Las Vegas, where most operators still thought in terms of odds, comps, and table limits. Sarno watched visitors arrive, gamble intensely, and leave the Strip without forming any emotional bond. To him, this was wasted potential. He believed the city was undercharging for its own myth. Sarno was also an outsider by temperament. He lacked the family networks that protected legacy casino owners and the informal immunity enjoyed by mob-backed properties. That absence of protection forced him to think structurally. If he was going to build something big, it would have to justify itself not just to gamblers, but to bankers, regulators, and middle-class Americans who had never set foot in a casino. This constraint sharpened his vision rather than limiting it. Sarno began to imagine a property that did not feel like a den of chance, but like a destination of authority and indulgence, something recognizable even to people who had never gambled. His idea was not subtle. It was deliberately oversized. He fixated on Rome not as history, but as brand shorthand, power, permanence, entitlement. In Sarno's thinking, guests wouldn't feel like customers, they would feel like rulers, temporarily elevated above ordinary life. This was a psychological proposition, not a gaming one. Yet Sarno underestimated one force: capital. His ideas required scale, and scale required debt. Unlike casino veterans who built incrementally, Sarno planned to leap ahead of the Strip in a single move. That meant borrowing aggressively, convincing lenders to finance something Las Vegas had never seen. He believed that if the experience was overwhelming enough, the numbers would follow. This faith bordered on stubbornness. Sarno trusted design more than spreadsheets, vision more than leverage ratios. It was this conviction, clear-eyed, innovative, and ultimately vulnerable, that set the stage for Caesar's palace. Long before the columns rose, the gamble had already been placed, not at a table, but inside Sarno's belief that imagination could outrun the structure of power in Las Vegas. The moment Jay Sarno stopped thinking like a hotel operator and began thinking like an emperor. His idea for Caesar's Palace was not to build the biggest casino on the Strip, but to construct an environment that imposed status on everyone who entered it. In Sarno's mind, Las Vegas didn't need another gambling floor. It needed a myth people could walk through. Rome offered that myth instantly. It required no explanation. Columns, statues, and symmetry communicated authority faster than advertising ever could. Sarno understood that gamblers behaved differently when they felt small, watched, and elevated at the same time. Caesars would not invite guests to play, it would grant them permission to rule. The design logic was deliberate. Long corridors slowed movement. High ceilings diluted time. The gaming floor was framed not as a pit, but as a forum, a civic space where money moved openly and confidently. This was not decoration layered onto a casino, it was architecture shaping behavior. Sarno insisted that the resort feel expensive even before a guest placed a bet. Marble, gold tones, and theatrical lighting created an atmosphere where spending felt justified, even inevitable. The name itself mattered. Caesars, plural, implied continuity and lineage. Guests were not visitors, they were successors. This framing turned risk into entitlement. Losing money no longer felt like failure, it felt like participation. Sarno believed this psychological shift would change how long people stayed, how much they spent, and how they remembered the experience afterward. But the Roman vision carried an embedded assumption that control of experience equaled control of outcome. Sarno assumed that if he could orchestrate the environment tightly enough, the financial structure would stabilize around it. He treated capital as a supporting actor rather than a governing force. This was a critical miscalculation. Rome, after all, was not just built on marble and myth, but on administration, supply chains, and discipline. Caesar's palace had the symbolism of empire, but not yet its defenses. As the plan solidified, Sarno was no longer competing with other casinos. He was competing with the Strip's entire operating philosophy. He was betting that spectacle could replace tradition, that immersion could outpace odds. The vision was bold, coherent, and historically disruptive. It was also fragile. Because once Rome was built, someone had to own it. And ownership in Las Vegas was never decided by imagination alone. The financing meetings that turned Jay Sarno's Roman dream from concept into liability. Caesar's palace was never designed to be built gradually. Its power depended on arriving fully formed, overwhelming the Strip in a single reveal. That requirement locked Sarno into a dangerous position. He needed large sums of capital up front, long before the first dollar of gaming revenue could stabilize the project. Traditional banks were cautious. Casinos were still considered volatile, politically sensitive, and morally suspect investments. Sarno's answer was leverage. He secured a $10.6 million loan from the Teamsters Central States Pension Fund, a source of capital that had become increasingly important to Las Vegas developments precisely because it operated differently from conventional lenders. The money came with fewer aesthetic objections and higher tolerance for risk, but it carried invisible weight. Pension capital demanded certainty, schedules, and repayment structures that did not bend easily to creative overruns. Sarno accepted those terms because he believed speed mattered more than flexibility. Every delay diluted impact. Construction costs climbed as the design expanded. Materials that communicated power were expensive, and Sarno refused to compromise. Caesars could not look almost imperial. It had to look unquestionable. Each decision pushed the budget higher and narrowed the margin for error. The project became capital-intensive not just in dollars, but in expectations. Once the loan was in place, Caesar's Palace no longer belonged solely to Sarno's vision. It belonged to a timetable. Cash flow projections hardened into obligations. The resort had to open strong, stay crowded, and generate revenue immediately. There would be no grace period. Sarno underestimated how quickly control shifts when money arrives before profit. He still thought like a creator while the financial structure around him had begun to think like an owner. This imbalance mattered. In Las Vegas, leverage does not simply amplify success, it transfers authority. Whoever controls the debt controls the clock. As Caesars rose from the desert, it carried two parallel architectures, one of marble and myth visible to guests, and another of contracts, repayment schedules, and oversight hidden behind offices and boardrooms. Sarno focused on the first and trusted it to sustain the second. That trust would be tested the moment Caesar's Palace opened its doors, because spectacle could attract attention, but debt demanded obedience. August 5, 1966, when J. Sarno unveiled Caesar's Palace as if it were a coronation rather than a business opening. The resort opened with a 14-story tower rising out of the desert, 680 rooms, and an atmosphere engineered to announce permanence. Sarno spent roughly $1 million on the opening celebration alone, an amount that signaled intent as much as extravagance. Hollywood celebrities, politicians, and industry insiders flooded the property, moving through marble corridors and beneath chandeliers that reframed Las Vegas luxury overnight. Caesars did not ask for attention, it commanded it. The gaming floor was busy immediately, not because of superior odds, but because guests felt they were part of something larger than a weekend trip. Sarno's theory seemed validated in real time. Visitors lingered, they dressed differently, they spoke about the property as if it were a destination rather than a stop. For the Strip, this was new. Caesars blurred the line between resort and theater, yet the spectacle masked structural strain. Opening night excess was not an indulgence, it was a requirement. Caesars needed momentum to justify its scale. Early revenues were strong, but they were quickly absorbed by operating costs that dwarfed older properties. Staffing levels, maintenance, and constant upkeep of the illusion required continuous spending. Unlike smaller casinos, Caesars could not afford to look quiet. Silence signaled weakness. Sarno had built a machine that had to stay loud. The debt clock began ticking immediately. Loan repayments did not care about applause or press coverage. They measured performance in weeks, not headlines. Sarno remained confident. He believed that sustained volume would smooth the numbers, that Caesars would settle into dominance. But the opening had locked Caesars into a narrow operational corridor. Any dip in traffic, any disruption in management, any tightening of credit would reverberate quickly. What looked like triumph carried hidden fragility. Caesar's Palace had changed the Strip's visual language in a single night. It had also raised the cost of failure. From that moment on, Caesars could not shrink, pause, or retreat. It had to expand, perform, and justify itself continuously. The opening proved Sarno's vision was correct. It also ensured that if control ever slipped from his hands, it would slip fast. The months after Caesar's Palace opened, when its true impact became visible, not in its balance sheets, but in the behavior of the Strip around it. Caesars did more than attract customers. It reset expectations. Competing casinos suddenly looked smaller, darker, and temporally dated. Guests who had walked through Roman columns and expansive forums began to question why they should return to low ceilings and narrow lobbies elsewhere. Caesars had introduced a new metric of success, not how fast money could be turned, but how long guests could be held. This shift altered development conversations across Las Vegas. Owners and operators began discussing themes, scale, and immersion as necessities rather than indulgences. The idea that a casino should tell a story visually, spatially, psychologically moved from novelty to requirement. Caesars proved that atmosphere could function as infrastructure. It justified higher room rates, longer stays, and broader non-gaming revenue. Shows, dining, and spectacle were no longer accessories. They became anchors. The Strip began its transition from a gambling corridor into a destination ecosystem. Yet this transformation came with consequences. Caesars' success compressed timelines for everyone else. To compete, rivals needed capital, speed, and tolerance for risk. Incremental upgrades were no longer enough. The Strip entered an escalation cycle that favored large-scale financing and institutional backing. This environment rewarded entities that could absorb volatility and punished individual visionaries who lacked deep reserves. Caesars had made Las Vegas bigger, but also less forgiving. Jay Sarno's influence was now structural, not personal. His ideas spread faster than his authority. As other projects borrowed the language of grandeur, Sarno remained tied to a single property, burdened by debt and expectation. Caesar's Palace had become a prototype, and prototypes are often outgrown by the industries they create. The Hostia Strip was learning to think in megastructures, but ownership was shifting toward those who could manage risk at scale. Caesars did not just change how Las Vegas looked. It changed who Las Vegas was built for, and in doing so, it quietly set the stage for the moment when its creator would no longer be necessary to its future. The moment Caesar's Palace stopped being judged as a spectacle and started being examined as a system. Scale brings attention, and attention invites oversight. As Caesars settled into operation, its size, financing, and visibility drew the focus of regulators, lenders, and institutional observers who had tolerated smaller casinos precisely because they were easier to ignore. Caesars was not. Its debt structure, particularly the reliance on pension-backed financing, placed it under a different class of expectation. Reporting had to be cleaner, governance had to be clearer, timelines had to be met. What had once been a visionary build was now an ongoing audit. Jay Sarno found himself navigating a landscape where creative control mattered less than procedural compliance. The property's success amplified this pressure. High revenues did not reduce scrutiny, they justified it. Caesars was too important to fail quietly and too exposed to be managed informally. Decisions that Sarno once made instinctively now required approval, documentation, and alignment with financial covenants. The operating philosophy of Las Vegas, fast, flexible, personality-driven, began to collide with institutional discipline. This collision revealed a deeper issue. Sarno's authority had never been absolute. It was conditional, sustained by performance and tolerance rather than ownership security. As oversight increased, so did the influence of advisors, accountants, and executives whose priorities centered on risk mitigation. They evaluated Caesars not as a cultural artifact, but as an asset. In that framing, Sarno's strengths became liabilities. His commitment to excess, reinvestment, and constant visual renewal conflicted with the need to stabilize margins. The same elements that made Caesars dominant also made it expensive to operate and difficult to standardize. Tensions surfaced quietly at first. Budget reviews tightened, expansion plans slowed. Questions arose about succession, sustainability, and exposure. Sarno resisted compromises that threatened the experience, but resistance itself carried cost. In leveraged environments, delay reads as instability. Control, once questioned, erodes quickly. The broader industry was shifting at the same time. Las Vegas was entering an era where legitimacy mattered as much as profit. Federal oversight increased across gaming. Public markets showed interest. Corporate structures promised continuity that individual visionaries could not guarantee. Caesar's Palace stood at the center of this transition, a hybrid of old Las Vegas bravado and new Las Vegas accountability. Sarno was caught between these forces. He had built a resort that demanded centralized vision, but the financial architecture supporting it demanded decentralization and restraint. The irony was sharp. Caesar succeeded so completely that it no longer needed the person who imagined it. Oversight did not arrive with accusations or scandals. It arrived with questions, meetings, and balance sheets. And in those quiet rooms, away from the marble and chandeliers, the future of Caesar's Palace began to be decided without J. Sarno at the head of the table. 1969, when Caesar's Palace was no longer a question of vision, but of ownership. 3 years after opening, the resort had proven its concept beyond dispute. It was busy, influential, and profitable enough to attract buyers who did not care about Roman mythology or experiential theory. They cared about scale, branding, and consolidation. That year, Caesar's Palace was sold to Lums, a publicly traded restaurant company, for approximately $60 million, a figure that reflected not just current performance, but the future Caesars had already reshaped. On paper, the deal looked like validation. Caesars had become valuable precisely because it worked. In reality, it marked the end of J. Sarno's control. The sale did not happen overnight, nor did it involve dramatic confrontations. It unfolded through negotiations shaped by leverage, governance, and fatigue. Sarno's position had weakened as oversight intensified and financial expectations hardened. Selling Caesars became framed not as surrender, but as necessity. Debt needed resolution. Stability needed assurance. Public ownership promised both. Sarno was outmaneuvered by structures he had helped invite. Once the transaction closed, Caesar's Palace shifted from a founder-driven project to a corporate asset governed by quarterly logic. Decision-making moved away from intuition and toward committees. The language around Caesars changed. It was no longer discussed as an idea, but as a portfolio component. Sarno remained associated with the property in name only. The operational culture he built was gradually diluted, standardized, and optimized. For Las Vegas, this transition signaled something larger. Caesar's sale demonstrated that the future of the Strip belonged to entities that could absorb risk across multiple holdings. Individual visionaries, no matter how transformative, were replaceable. Sarno's departure was quiet, but its implications were loud. It showed that creating the new standard did not guarantee participation in the next phase. The irony was complete. Caesar's Palace had been designed to make guests feel like emperors, but its creator had no throne once the empire matured. Sarno left behind a resort that continued to define Las Vegas luxury while he faded from public relevance. There was no scandal, no dramatic fall from grace, just a transfer of control executed through contracts and signatures. In Las Vegas, power rarely announces itself when it changes hands. It simply moves. And in 1969, it moved away from J. Sarno, marking the moment when Caesar's Palace became immortal and its founder became expendable. The years immediately after J. Sarno lost control of Caesar's Palace, when the Strip continued to grow louder while he grew increasingly silent. Without Caesars, Sarno no longer occupied the center of Las Vegas conversations. He did not transition into a power broker, nor did he reinvent himself as a serial developer. Instead, his absence revealed how little space the city reserved for founders once their structures were absorbed by larger systems. Sarno attempted other projects, but none carried the momentum or protection that Caesars once provided. The industry he had helped reshape was now optimized for corporate balance sheets, not individual conviction. Ideas mattered, but only when paired with capital that could survive volatility. Sarno's instincts, once celebrated, now appeared risky. Lenders and partners viewed him as a creative force without the institutional backing to buffer mistakes. In a city that rewarded winners relentlessly, yesterday's innovator became tomorrow's cautionary example. Caesar's Palace continued to thrive, expand, and evolve, but it did so without reference to Sarno's original philosophy. The experience became more efficient, more modular, more predictable. What had once been an act of imagination hardened into a formula. Sarno watched as others applied variations of his concept at larger scales with greater financial insulation. There was no public reckoning, no apology, and no restoration of status. Las Vegas does not mourn quietly displaced figures. It replaces them. Sarno's decline was not marked by bankruptcy headlines or courtroom drama. It was marked by irrelevance. Invitations stopped arriving. Influence evaporated. The man who had convinced a city to think in empires could no longer command an audience. This was not cruelty. It was structural indifference. The Strip had learned from Sarno and moved past him. His loss exposed a central truth about Las Vegas power. Creation does not equal control, and innovation does not guarantee permanence. Sarno had built a machine that no longer required his presence. In doing so, he paid the highest price the city demands from its visionaries, the surrender of authorship. Caesar's Palace stood as proof of his success, but also as evidence that the city's rewards flow forward, never back. What was left behind when J. Sarno exited the center of Las Vegas life, because the consequences of his removal were not confined to boardrooms. For Sarno himself, the loss of Caesars was not only professional, but personal. His identity had been bound to creation, to the act of building something that changed how people behaved and felt. Once that role was taken away, there was no equivalent replacement. Unlike corporate executives who rotate between assets, Sarno had no institutional ladder to climb. His influence had been singular, and once severed, it did not regenerate. For those close to him, the shift was disorienting. Las Vegas had a way of validating people through proximity to power. When that proximity vanished, so did the relationships that depended on it. This pattern extended beyond Sarno's circle. Caesar's transformation into a corporate asset altered how labor, management, and creativity interacted across the Strip. As ownership structures hardened, decision-making moved further from the floor and closer to distant offices. Employees gained stability but lost intimacy with leadership. Vision became segmented into departments. Risk was redistributed downward. For the city, this was progress, but it came with a quieter cost. The era of personal myth-making began to close. Founders became less visible. Stories became cleaner, safer, and easier to market. Caesar's continued success reinforced the lesson that Las Vegas no longer needed singular figures to define it. The Strip could now reproduce innovation through process rather than personality. Sarno's experience served as an unspoken warning to others who followed. Imagination was welcome, but only temporarily. Once codified, it would be owned. The community adapted quickly. New names replaced old ones. New resorts eclipsed prior landmarks. Caesars remained, but its origin story faded from public memory. This erasure was not malicious. It was efficient. Las Vegas thrives on reinvention, not retrospection. Sarno's legacy persisted in concrete layout and strategy, but not in daily conversation. The city absorbed his ideas and shed his presence. In that absorption lay the final consequence of his rise and fall. Sarno had helped Las Vegas grow into a place that could survive without its pioneers. The city he changed did not destroy him. It simply continued, leaving behind the human cost of progress in a place that never slows down to look back. By the time Caesar's Palace had fully transitioned into corporate hands, its most important work was already done. The resort had rewritten the operating logic of Las Vegas, shifting the Strip away from transactional gambling and toward experiential dominance. Caesars proved that scale itself could be monetized, that architecture and narrative could slow guests down, hold their attention, and justify higher spending across rooms, dining, and entertainment. This was not simply a design breakthrough, it was a structural one. After Caesars, no serious Strip development could ignore immersion. Themed environments became financial instruments. Luxury stopped being optional and became expected. Caesars established the template that later megastructures would refine rather than reinvent. Its influence can be traced in the rise of integrated resorts, where casinos function as anchors rather than destinations in themselves. Non-gaming revenue streams expanded because Caesars demonstrated that guests would pay to remain inside a story. This recalibration of priorities altered how investors evaluated projects. Risk was no longer measured solely by gaming volatility, but by experiential coherence. A property that could command identity could command patience from capital. In this sense, Caesars did more than succeed. It professionalized ambition. Jay Sarno's role in this transformation was both foundational and obscured. His ideas endured even as his authorship faded. The Strip absorbed his vision and institutionalized it, distributing responsibility across boards, executives, and shareholders. Caesars became a case study taught implicitly through imitation. Resorts grew taller, themes grew bolder, and budgets grew larger, all justified by the precedent Sarno had set. Yet this legacy carries an inherent contradiction. Caesars validated the power of singular imagination while simultaneously proving that imagination alone could not retain control. Sarno's fate underscored a rule that would govern Las Vegas going forward. Innovation opens doors, but capital decides who walks through them. The city learned to harvest ideas without preserving their originators. Caesar's Palace remains a living monument to that lesson. Guests continue to walk its corridors, participate in its illusion of entitlement, and spend within its carefully engineered spaces, largely unaware of the man who conceived the experience. Sarno's legacy is not commemorated in statues or plaques. It exists in the Strip's DNA, replicated endlessly in glass, steel, and spectacle. Caesars changed Las Vegas by teaching it how to sell power as an experience. That idea survived its creator, shaping a city that remembers results far longer than it remembers the people who made them possible. Caesar's Palace still stands on the Strip, evolving, expanding, and absorbing new layers of spectacle. Yet its presence raises a question Las Vegas rarely asks aloud. Who is remembered in a city built on reinvention? Jay Sarno changed how Las Vegas defined luxury, scale, and ambition, but his name is not etched into the daily mythology of the Strip. The city remembers outcomes, not origins. It celebrates structures that endure and systems that generate profit, while the individuals who initiate transformation often disappear from view once their ideas are secured. This is not moral judgment, it is a pattern. Las Vegas is designed to move forward, not to look back. In that movement, legacy becomes abstract, detached from biography, and anchored instead in architecture and revenue. Caesar's palace is proof that a single vision can reshape an industry, and also proof that vision does not guarantee ownership of its consequences. The question Sarno's story leaves behind is not whether he succeeded, but whether success in Las Vegas is ever meant to be personal. In a city where everything is replaceable except the illusion, perhaps the greatest risk is not failure, but being remembered only through what survives you.